Okay, so the next section in chapter 2 talks about journal entries and kind of what impact do these transactions that are taking place have on the accounting equation. So journal entries are used to record accounting transactions. All journal entries are double-sided. That means for every action, there's a reaction. You have to make sure that each journal entry has at least one debit and one credit. And I say at least. Some journal entries will have 6 debits, 1 credit. Some journal entries will have 2 debits, 5 credits. But the amounts must equal, and you must have at least 1 debit and 1 credit. The way I kind of rationalize it to myself is I ask myself 2 questions. What happened and how did it happen? Usually asking those 2 questions, I say usually, asking those 2 questions will get you to where you need to go as far as answering and determining what account should be hit on the journal entry. So in the book, it kind of outlines it as how do journal entries affect the accounting equation. So in illustration 2-2, they have a few things that happen. So we'll just go over a couple of those. I highlighted transaction 1, transaction 3, and transaction 5. Right. So the first transaction says that the company sells common stock, $200,000 worth of common stock to get cash. So the way that would work is your debit would be to that asset. Remember how we just went over the debits and credits. Your asset account is going to be a debit of 200,000. So for transaction 1, you would have debit to cash because you sold common stock to get cash, right? So if you think about it from a company's perspective, when they sell stock, they receive the cash from the individual. So you would debit cash, you would credit equity for 200,000. That's highlighted here. And if you think about our our accounting equation, it still balances, right? 200,000 in assets, 200,000 in owner's equity. So this is the first journal entry for transaction 3. We'll skip over to transaction 3. Transaction 3 states that you purchase equipment for the business for $120,000 cash. So the way this journal entry will look is your debit is going to be equipment. Remember, that's our asset. So assets are increased by debits for 120,000. Our credit is going to be cash, which cash is an asset account as well. So you can hit both an asset account on one transaction. On one journal entry. It can be a debit to an asset, a credit to an asset, a debit to a liability, a credit to a liability. So here we'll credit cash for 120,000. So if we kind of look at the question I asked, it says what happened? Well, we purchased equipment. How did we purchase it? With cash. That's really major because on the next transaction, transaction 5, we have that we purchase supplies on account. Anytime it says that we purchase something on account, that means that we did not pay cash for it. That means that we have opened up a line of credit with whatever company that we purchased from. So in 5, it says we purchase supplies on account. So what we're going to do is increase our supplies with a debit to our supplies for 23,000, and then a credit to accounts payable for 23,000. So that to me is why the how did it happen matters, is because how did we pay for this? Either we use cash or we use an account. So if we use cash, then we decrease cash. If we pay for it via accounts payable, then we do not touch the cash account. We credit accounts payable, which is a liability account, and we debit our asset account. So if you come over here and look at how these affected our accounting equation, you have the first entry was for 200,000. You increase your assets 200,000. You increase your owner's equity 200,000. Good. The third entry, you increase your equipment 120,000. You decrease your cash 120,000. That's a wash on the asset account. So your balance in the asset account and your formula is still equals. Here we have that we purchased supplies on account for $23,000, and we did that on account, so that would go to the liability side. So here we have $23,000. So to total this off, just so you kind of see how these impact the accounting equation, we have entry 1 for 200,000 here, entry 5 for 23,000 here, and then equals, we have entry 1, 3, and 5. Since 3 netted out, that's a zero impact on the equation. So you have 200,000 plus 23,000, which is 223,000 total, which equals here. So this is really quick way to understand how they affect the accounting equation. You have 223,000 here total for the transactions that we covered, 223,000 here in your owner's equity and liabilities, and they still equal. And then we walk through the journal entries for each one and how the debits and the credits worked.